gold will start to get recognized again, and it's the central bankers that have done it. Too many of the retail guys are being seduced into. As the 60-40 became, in actual point, people spoke about it. It used to be 20% in gold, sometimes 10, sometimes at minimum 5. But there was always a gold slice. That just got eliminated. That was the 40-year period of the financialization of everything, where they immortalized the 60-40 portfolio that took out the insurance against central banker malfeasance, which is exactly where you need to be. You need to be over-insured now. You could be 40% gold, and there's no rule. Listen, you need to be positioned for times where you are in. And subject to risk profile, you could be heavily overweight precious metals and gold.
Gold prices climbed on Monday, driven by heightened safe haven demand due to the ongoing conflict in the Middle East. Investors also closely monitor the U.S. Federal Reserve's interest rate outlook and former President Donald Trump's tariff policies, which could influence the metal's trajectory into 2025. Market analyst FrancisHunt states that decades of financialization have reduced gold's presence in portfolios, stripping away its critical role as insurance against central bank risks. He advises investors to reconsider their allocation strategies in today's uncertain economic climate, suggesting that gold holdings could increase from 5 to 10% to 40%, depending on risk tolerance. Meanwhile, the gold-silver ratio, a key market indicator showing how many ounces of silver are needed to equal the value of 1 ounce of gold, stood at 89.02 on Monday, largely unchanged from 89.03 on Friday. Historically, this ratio often signals market stress, with silver expected to outperform gold in certain cycles. Silver, which increased over 20% in 2024, has recently lost momentum due to higher U.S. yields, a stronger dollar, and slowing global growth. It is currently trading near its 200-day moving average, with an increase in speculative short positions, while exchange-traded fund holdings have stabilized after earlier outflows. Analysts suggest that silver could regain strength, as UBS highlights the unsustainable gold-silver ratio now above 90x unless a global recession occurs. While silver lacks strong central bank support, rising gold prices may still provide some backing. In the future, both gold and silver markets may experience significant changes. Investors should remain cautious, taking advantage of dips and monitoring economic indicators that could impact market conditions. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Gold will start to get recognized again, and it's the central bankers that have done it. Too many of the retail guys are being seduced into. As the 60-40 became, in actual point, people spoke about it. It used to be 20% in gold, sometimes 10, sometimes at minimum 5. But there was always a gold slice. That just got eliminated. That was the 40-year period of the financialization of everything, where they immortalized the 60-40 portfolio that took out the insurance against central banker malfeasance, which is exactly where you need to be. You need to be over-insured now. You could be 40% gold, and there's no rule. Everybody goes, oh no, you don't want to say too much of that. 5%, 10%. Listen, you want to be positioned for the times you are in. And subject to risk profile, you could be heavily overweight precious metals and gold. Not currently performing. But anyway, but having had a great year, by the way, still $2,622, smashed through the 2K this year. We had a beautiful setup that we traded with leverage on that a while back. The breaking of the gold-silver ratio. So what does that do? Well, it shows distress and a bit of risk off. What's actually happening is silver should begin outperforming gold at some point. That's not going to happen. We put the red line here. This is the one we expected to be broken. After this failure, where it only spiked below 75, couldn't hold it, and came all the way back in, we said the cycle is extending, and you'll probably find gold will be indifferent. If we're getting a super spike in the dollar, you will see gold actually go down in dollar terms, and silver even more so. That's going to be useful for securing supply for the likes of Elon, the military industrial complex, the solar panel guys, and everybody else. They should grab all they can get of silver. So in short, we predict that the gold-silver ratio is going to extend higher. And that is bad medium term, short medium term for gold. So remember, we're talking about dollar strength here, real dollar surge. That's going to see a double against the Korean won, take real bites into the Australian dollar as a result of the debt-based collapse. So in that period, it's going to be a tough call for everything that challenges the dollar. Dollar long. That's where dollar milkshake is right and accurate. There will be upside in the dollar for a while. It's not going to be sustained forever though, and it should be treated more as a schizophrenic spike than real strength, because it's debt-based collapse that is driving it. It's interest rates, leading the interest rates hike as a result of your debt devaluing most. So this is a bad period with the precious metals guys are going to have to go into one of those long doldrums, patience moments of buying on the cheap in collapses. So keep your cash, that which you have spare, accumulate it, and buy on the dips. There will be plenty dips made available, I expect, particularly on silver. So these were key breaks that occurred that we covered in the newsletter. A 30-year setup that is huge on the Korean won. A major breakout on the gold and silver ratio in the wrong way, all supporting dollar strength.
The United States faces a looming threat of default on its national debt, a scenario that could severely damage its credit rating and ripple across global financial markets. This crisis, rooted in the contentious debate over the federal debt ceiling, has alarmed investors, policymakers, and international allies alike. With the debt ceiling set to be reinstated on January 1, 2025, the Treasury Department's extraordinary measures to keep the government funded are expected to run out by mid-year. This timeline places immense pressure on Congress to find a resolution before the U.S. risks defaulting on its obligations, a move that could unleash unprecedented economic turmoil. Market analyst FrancisHunt views the current situation as part of an impending collapse of the fiat-based debt system. Hunt warns that not addressing the debt ceiling or defaulting could reduce fiat currency's purchasing power and destabilize markets, eroding global confidence in the U.S. financial system. While there may be a temporary rise in the U.S. dollar as investors look for safety, this dollar schizophrenic spike would reveal systemic vulnerabilities rather than true economic strength. A prolonged stalemate could lead to higher borrowing costs, disrupted government operations, and a drop in public trust, increasing volatility in international markets already strained by economic uncertainties. Let's get back to the interview.
The overall chart. Your debt system is your fiat system. Collapse in debt will lead to collapse in buying power in currency after the debt finds its floor. So they take turns like left and right to collapse. We are looking at the debt collapse, and the dollar will actually be relative to other fiats, and for a short while even against gold, and risk off. Everybody will sell everything that isn't nailed down. For a while, you will have the dollar schizo spike, which is not a healthy event to be applauded. USA by the likes of the milkshake boys. It's going to be a spike, not a holding point, which will be maintained, because post the debt collapse, as you've shrunk the debt ball, money is borrowed into existence inherently and is a T account. Once you've melted down the one half, the other half comes down substantially as well. The buying power of the fiat when you have debt collapse also subsequent to the debt collapses. They don't do it at the same time. It's like an alternating. You don't walk your left foot forward at the same time as your right, otherwise you'd be bunny hopping. So having a blow off relative to other fiats in a schizo spike is not winning. It's part and parcel of a stage collapse of your own debt system, which you'll see people no longer fund your level of expenditures that you have had as an exorbitant privilege. And what that then means is you can only spend at government level as much as you're getting in with only minor borrowings instead of doing 2x what you've been getting in. That suddenly means you're, as services, going to get a lot less. The American highways are going to be a lot less well kept. Rubber carcasses from blown tires will be left all over the place. It's already happening when I was there in Florida. You are going to see a decline, your infrastructure, in a lot of things. It's not something to be applauded in that for what will turn out a New York minute, you're going to have a super spike in your currency. This is contagion and collapse. This is not a point of nationalistic pride. And that's my issue with the dollar milkshake guys. When you talk about a dollar surge on a schizo interest rate based spike, you are actually bragging of your debt collapsing more and harder than anybody else. And the resultant move in the interest rates is for short term, seeing people take the higher yield that is being offered on the dollar, that sees more money run into the dollar, that sees the dollar get bid up at the expense of other fiats. But it doesn't stay that way. That's hot money. It's hot money that chases the yield and then leaves just as fast as it came.
As economic and geopolitical challenges escalate, the role of precious metals and the stability of fiat currency systems face heightened scrutiny. Investors are urged to reassess their portfolio strategies, considering the shifting dynamics in gold and silver markets and the broader implications of fiscal uncertainties. With mounting pressure on global financial systems, proactive measures and vigilant monitoring of key economic indicators will be essential in navigating the complex landscape ahead. What strategies do you believe are most effective in preparing for potential shifts in global financial systems and market volatility? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.